Welcome to another edition of Taking Stock for the week ending the 29th of November 2024. I'm Kien, Head of Research at Stock Doctor, and joining me today is our equities analyst, Daniel Ortisi, to stream to you all things share market. I can't believe, Dan, it's already near the end of the month. It's incredible how time just goes past, and this month has been a very, very interesting one for equity markets.
Yeah, good to be back, Kien. Like you said, the year's just gone so fast, and yeah, just some continuation of very strong performance for Star Stocks. Promedicus during the week, a really large contract win, and that was a big talking point amongst the team, wasn't it?
Yeah, incredible, Dan. I mean, with our star stocks over the month, it's been another positive month for them. But before we get started, just a quick yet important reminder: the information we provide today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Now that we've got that out of the way, Dan, equity markets here and in the US, they continue to hit new highs, and that's due to these easing geopolitical tensions in the Middle East following a potential ceasefire agreement between Israel and Hezbollah. In addition, we also saw economic data in the US suggesting that the economy has expanded by about 2.8% per annum, driven by the consumer spending segment, which is up about 3.5% for the year. So and you can see this with the chart on screen, which highlights the resilience of the economy despite lingering inflation pressures and the political uncertainty.
Yeah, it really kind of reinforces the fact of blocking out the noise, doesn't it, Ken, and focusing on the underlying fundamentals of the businesses that we follow. A case in point this week came from notable former Star stock back in the day, women's fashion retailer City Chic, a company which is currently in distressed financial health due to its lack of profits, cash flows, and high debt. So really, like we're reinforcing, blocking out the noise and focusing on the fundamentals, which clearly for this business look quite poor, and hence the company dropped around 27% on that AGM trading update, Kian. The stock is now down around 65% over the year, which is in stark contrast to the consumer discretionary sector, which has risen by around 30% for the year to date.
Yeah, it's been quite a strong sector, but not very strong for City Chic. Now, investors may be attracted to its valuation as well under Golden Rule 5, and it appears to be trading at quite a steep discount to fair value. But given the heightened risk to its financial health and also the earnings headwinds, we would consider City Chic more of a value trap. That is, stocks that have fallen for really good reason and should be avoided.
And speaking about stocks that have been under pressure, Kian, earlier on in the week, we decided to release the removal of our lithium stocks under coverage, which is Pilbara Minerals, Lynas Rare Earths, and Mineral Resources. The removal has been driven by ongoing uncertainty regarding the outlook, specifically with regards to negative earnings revisions and lack of growth for this financial year and the financial year ahead. This can lead to confusion amongst investors, particularly when we categorize these stocks as quality growth stocks.
Yeah, that's right, Dan. We want sustainable growth in our businesses, the portfolios that we hold. But for our members, though, excluding them from our Star Stock universe doesn't mean that we will cease coverage on them and completely. We still believe in the long-term outlook for battery metals and green energy, and we'll be here to help answer your future questions on these stocks. In the meantime, please refer to our commentary to understand the rationale for our decision. Further to this, though, following the AGM, we've also currently undertaking a full review of our Star Stock portfolios just to ensure that we have the highest quality growth and income stocks presented to our members.
And for instance, Ken, we also decided to remove tourism bus operator Kelsian Group due to its lack of growth prospects in the near future. And that's also driven by increasing capital expenditures in the near term and challenges to integrating its US acquisitions, particularly the coach business All Aboard America. Within our Star Income Stock universe, however, we've initiated coverage on a handful of REITs, industrial property storage company, National Storage Group, and essentials retailer Homeco Daily Needs. These stocks are expected to go ex-dividend at the end of December and currently pay an attractive above-market dividend yield.
Yeah, some of the REITs now look quite attractive relative to the rest of the market. They've been sold down and they haven't really rallied as strongly. So perhaps an opportunity there. But we'll also be conducting a full review of the banks after their reporting season, which we're doing right now. And with most of them increasing their dividends on the back of, the positive outlook commentary and also the slight earnings, positive earnings revisions that's coming through. It'll be interesting to have a look at some of these regionals. In fact, we have initiated coverage on Bendigo and Adelaide Bank, which continue to pay quite an attractive gross dividend yield of about 6.9%, despite the share price trading at all-time highs, Dan.
That's right, Ken. And the commentary, as always, is on Stock Doctor. So for members who are interested in that, please make sure you go ahead and read through. Moving now to some Star Stock updates throughout the week. Maybe let's start with IPD Group, Kien, obviously an electrical distribution company who's also investing in areas such as renewable energy, electric charging stations, and data centers. The company released a trading update this week for the first half of the fiscal year 25, which revealed around a 9% decline in earnings after removing the impact of acquisitions. Did you want to give us a little bit more information around the trading update, Kien?
Yeah, Dan, I mean, the market reacted quite negatively to this update, and that led to that significant share price decline. Investors are likely concerned about the decrease in margins and the lack of full year guidance, which introduces quite a bit of uncertainty regarding the company's future performance. And they also alluded to this margin pressure on the back of complex projects and challenging macroeconomic conditions as well, Dan. So,
It's right, Ken. Good points, and something we're going to continue to monitor going forward for the business. In addition, the lower level of liquidity on the stock may also contributed to that excessive downside volatility. So if someone's willing to sell the stock, the low amount of liquidity means that they might have to push the price down a bit further than if there was more liquidity on the table.
yeah,
Shift,
especially if a small institutional investor wants to sell out here, given that its average daily liquidity is around 800K per day. Now, shifting gears, Dan, Wisetech Global now recently revised their financial year 25 guidance lower, and that contributed to some weakness in the share price as well. And for those who are not familiar with Wisetech, the company is a global provider of logistics software.
yeah, Wisetech's earnings downgrade stems from delays in the launch of its container transport optimization project, Ken. Originally, that was set for the first half of FY25, and the launch has been pushed back to the second half, partly due to what the company calls media attention, acting as a temporary distraction to the business.
Yeah, very interesting there, Dan. Regarding all the governance issues, how can that affect their operating earnings? But this temporary distraction has resulted in lower earnings guidance, which has revised down by about 7%. And we would expect the negative earnings revisions to flow through. I don't think the market is done with this one yet, Dan, and expect further volatility in the short term.
Yeah, good point, Ken. It's always difficult to foresee some volatility, but that's certainly the thematic for this stock at the moment. It's also worth keeping an eye on how the interim CEO, Andrew Cartledge, navigates this transition period, as it could shape the company's trajectory moving forward. Although, of course, founder Richard White is expected to continue driving the strategy in a more consultancy-based role, Ken.
Yeah, definitely there, Dan. And on other news this week, Dan, and you mentioned this earlier, medical imaging software business Promedicus, they continue to power ahead after announcing another contract win. This is the largest one to date, representing an additional 33 million per year in revenue, and this should continue to drive positive earnings revisions for this stock.
Yeah, Promedicus has it's just been an incredible success story by far, Kian, for us and our investors and members, despite perennial concerns around valuation across the broking community. And this is why it is important not to place, I guess, too much emphasis on valuation, because quality companies such as Promedicus, is a perfect case study on potentially why you need to pay a premium for these quality businesses which continue to outperform.
This week, for Under the Microscope, we focus on Lovisa Holdings, founded in 2010 by retail billionaire Brett Blundy, who still holds close to a 39% stake now. Lovisa specializes in that fast fashion jewelry targeting young consumers seeking affordable on-trend pieces. But Dan, look at its return on equity, incredible, isn't it? But why is it so high?
Yeah, good question, Ken. One we get asked about quite a bit with this business. The company's high return on equity is driven by several factors. One of the most important factors is its low cost store footprint, which of course results in a lower amount of contributed equity by the company.
Mm.
a strong vertical supply chain that helps control costs, and a minimal reliance on traditional marketing, instead leveraging social media to reach the younger demographic.
Yeah, that's quite a smart move there, focusing on the target audience. But its recent trading update, Dan, was a bit of a letdown, wasn't it? Both the like-for-like sales growth of around 1% and total sales growth of 10% for the financial year to date came in slightly below market expectations. Yet the share price reaction wasn't too dramatic. The share price appears to be factoring some of that negativity beforehand, hasn't it?
Yeah, it's a good, I guess, observation, Ken. The stock had been underperforming into the trading update, and we obviously saw that it somewhat recovered once the trading update was announced, as you said. During the AGM, Brett Blundy reassured investors that the strong growth pipeline for the business was still intact, and it looks like their earnings growth story will hinge more on the store rollouts rather than like-for-like sales growth at this point. So far this year, they've added 27 net new stores, bringing the company's total to 927 stores across 49 markets. That's quite an impressive scale for the business, but the next 24 to 48 months will be very critical, especially in regards to their growth in Europe and North America, which are their two key markets at the moment. And I suppose the emerging markets in Asia is what the market is looking at to be its next new big growth frontier after that, Kian.
Yeah, definitely, Dan. Succeeding in the crowded Asian markets where there's, a lot of cheap jewelry around is no easy feat. But there are some risks we need to be watchful of as well. You've got the negative earnings revisions coming through now, the rising short interest, which we're monitoring quite closely, and then there's the management transition as well.
Definitely, well said, Ken. And obviously, you always have to take into account the active risks in any stock. But despite these challenges, we still believe that Lovisa's overall quality does stand out on the share market. It's a solid company, very strong margins, and as we touched about, that high return on equity. So even with these risks lingering, we think it is a business worth highlighting as a star growth stock to our members. The lower interest rate cycle could also ultimately provide a tailwind for these businesses as people may be spending more on discretionary items, Kian.
Yeah, definitely. This one's the one to watch as we head into the new year, especially with interest rates and how they move. But it's going to be quite interesting, and we'll see how they execute, especially their geographical expansion in the coming year. And as this year comes to an end, and with our star growth stocks generating a return of close to 30% over the year, it's an opportune time for investors to review their portfolio so that they are not overly concentrated to any single stock exposure. So the question this week is, how can I rebalance my portfolio on Stock Doctor?
Yeah, very good question, Ken. And to do this, we have to start by selecting one of the portfolios under the Portfolio Manager, then select the Portfolio Optimizer tab. Here you'll be able to view and adjust the level of exposure you have to any single stock. Then you can simply reduce the stock weightings for those that take up a large portion of your portfolio. We typically suggest no more than a 10% weighting to any given stock.
Also, Dan, I noticed there's a color-coded system here, which allows you to visualize whether the stock in your portfolio aligns to your objective and risk tolerance. You may wish to remove stocks that show this red circle there, and these usually represent stocks that are either unhealthy or are not star stocks. However, if you have a strong case for keeping some of these stocks, you can simply exclude them from the profile alignment by clicking on the lock symbol on the portfolio at the left-hand side.
And next, you may want to replace the stocks you have removed again by reviewing the optimized suggestions on the right-hand side. These stocks have been generated by a proprietary algorithm, which gives you a list of stocks based on your objectives, taking into account the existing stocks in your portfolio.
Yeah, that's quite a complex system, Dan, but it helps in managing the risks of your portfolio, selecting the best one for that risk-adjusted return metric. But once you have added all these stocks, you can rebalance your entire portfolio by simply clicking on the weight evenly button. Instructions on the number of shares to buy and sell can be found then by clicking on the view orders button. So the portfolio manager makes everything quite simple, Dan, but I think that's all we have time for today.
Yeah, it's great. Another great weekend. And yeah, just as we said at the start of the show, fantastic to get some very good performance from our star stocks. And hopefully our members have enjoyed that performance this year.
Yeah, definitely. And if you have any questions on our episode today, please feel free to contact our member relationship team, or otherwise you can attend our Lincoln Live webinar on Monday. Remember, block out the noise. Markets are hitting new highs. Focus on the fundamentals. Take care and have a happy, healthy, and prosperous week ahead.